In today's discussion, we will cover the topic of contribution margin. First, let's clarify an important distinction: cost versus price. In everyday conversations, we often use these two words interchangeably. What is the price of this textbook? This textbook cost me $60. But in financial discussions, it is important to know that we mean two very different things when we say cost versus price. When we talk about components of a product's price, the cost is the cost of the product to the business, whether the business produced or purchased this product from someone else for resale. Businesses usually don't sell products at cost. The price at which the end customer buys a product is usually higher than the cost incurred by the business to make the purchase in the first place. The price of product or service is also what we refer to as revenue per unit. Every time a product is sold, the money the business receives for it, the price of the product, adds to the organization's revenue. The sum of all of the prices of all of the products sold is the company's total revenue. The difference between the price of the product to an end customer and the cost of the product to the business is what we call a contribution margin. Let's look at the components of price more closely. I said earlier that price is a sum of cost and contribution margin. More specifically, price is the sum of variable cost and contribution margin. Variable costs are the costs directly involved in production and sale of products, like raw materials, parts, packaging, shipping, sales commissions, and wages of temporary employees. Because variable costs are incurred with production of each item, these costs are usually expressed in dollars per unit. If you're not confident in your understanding of variable versus fixed costs, please go back to the Types of Expenses video. When a marketing manager determines a price for a new product, she should first consider how much this product costs the company to produce and sell. That is the variable cost per unit. On top of the variable cost, she will add what is called a contribution margin. This way, not only does the product's price cover the costs to make and sell that product, the company also makes a little extra on top of that variable cost. You may be thinking that this difference between price and variable cost is the company's profit from selling the product. That is not entirely true. Recall that each business also has fixed operating costs, the costs involved in sustaining ongoing operations of the business. Where does the organization get the money to cover those fixed operating costs? The answer is from the contribution margin. Each time a product is sold, a portion of the revenue contributes to covering the fixed operating costs. That is why we call it a contribution margin. Once the product sales have covered both variable costs and the fixed operating costs, the company starts making a profit, which would also be sourced from the contribution margin. We will talk more about profits and profitability in the upcoming break-even analysis video. For now, you need to know that a product's price is the sum of variable cost and contribution margin. You can rearrange this equation depending on the question being asked of you. Let's look at some examples. A handmade pair of slippers costs $13 to make. This includes the cost of wool, leather, and thread. You sell the slippers at a local market and would like to add a $6 contribution margin per pair sold. What should the price of each pair of slippers be? The answer is 19. A textbook costs $54 to make and is sold at the bookstore for $70. What is the contribution margin per textbook? The answer is $16. You bought a bicycle from the store for $149. Your friend works at the store and told you that the store makes a $29 contribution margin on each bicycle. How much does it cost the store to buy the bicycle from the factory? The answer is $120. I hope you have found this video helpful. If some parts of the topic are still unclear to you, review the video again and ask your instructor for clarification.